Hello, ladies and gentlemen. My name is Greg Michalowski. I'm the Director of Client Education and Technical Analysis for ForexLive.com. And this is kind of a repeat of last month because we go from one month to the next month, and we have another Fed decision. This is the October decision. I did this last month, and it just so happened that the webinars that they assigned to me came each on the day before the Fed decision. So I don't mean to be redundant. A lot in trading has to do with being redundant anyway. You should always have a mission. You should always have a plan. You should always follow that plan. You should be disciplined in what you do, how you do it. So when we come into some things like this Fed decision, it we have to reinforce what we should do and how we look at something as key as this decision. Not only what may happen tomorrow, but what may happen in the future, and what we can potentially take away and potentially trade off of. And that, well, we'll just go in. We'll just let it happen during this webinar. Before I get started, let me remind everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. So before you just trade, make sure you consider your trade objectives, your risk tolerance, and understand that you can lose all or part of your risk capital in the foreign exchange market. So be aware and be prepared for that, folks. Well, it's finally here, the October Fed decision, and I had the same slide last year, but it said the September Fed decision. But the one thing I can add this month is that there's only one more left in 2015. And what has the Fed been talking about all of 2015 practically? Lift off, lift off, lift off. I still expect that we're going to have a Fed tightening by the end of 2015, or at the beginning of the year they were looking for four tightenings by the end of the year. What kind of crazy people do we have leading the Fed charge? But if you look at their dot graph or their dot plot or whatever you want to call it, at the beginning of the year or the end of last year in December, they that's what they're calling for. Everyone has the courage of 1,000 matadors when it's a year out. When you're sitting in the December of 2015, we can look at December 2016 and say, oh, I think the Fed's going to tighten by 4 or 5 or 6 different times between now and the end of the year, a year of 2016. And then all of a sudden you get caught in the little minutia of what happens on this little data and this little data and that. I'm not saying, the Fed probably had some windows that were opened up at certain points along this way toward taking out all the stimulus as far as rates go. There were better times in the first quarter and into the second, and then things started to turn a little sour in the things started to turn sour at the beginning of the year, and then in the second quarter, we got a little bit of a rebound, and now third quarter is looking like garbage again, with estimates for GDP being again lowered again today with the durable goods orders which came out. As I can see, pretty horrible. We also just had consumer confidence come down to 97.6 from 103, just announced right before we got started here. Richmond Fed Manufacturing Index. Oh wow, a bright spot. It was only down -1 versus -3 expectations and -5 last month. So, oh, happy days are here again. It's only -3. The durable goods orders today. I don't know. You can't see. I don't see anything positive in that from the U.S. perspective. But so the Fed has a lot on its to look at here, and things aren't looking all that better. So what do we know? And if you're gonna trade an FOMC decision, you try to think like the Fed. Try to go through your ABCs, if you will. Um, Part one was last month. This is part two, so that's the reference to that. So, but it was kind of this, same thing, different different month, Boyke. So what do we know? What do we know? Or if you're going to look at the um, if you're going to try to trade the FOMC decision and try to make some sort of judgment as far as what going on, you can take the shortcut and you can say that well, zero economists expect the Fed to tighten rates, but it really isn't about tightening. Now, I actually a few we or a week or so ago there was there was this inkling in my mind that okay, Fed said that there's a chance for a lift. That liftoff is going to happen in 2015. Do I think December is a great time for a liftoff to happen? Well, traditionally it's not because it's going into the holiday season, and the Fed could get criticized for that, or it can hurt retailers. It's the biggest shopping part of the year. And if the Fed comes out and starts to tighten rates and makes headline news, stock market starts to go down, all that other stuff, what are they going to be doing to the retailers out there when they get all the Christmas? They need December. They need December. And so traditionally, it hasn't been a time for the Fed to act unless things are really, 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 really cooking. So although October there's no press conference and all, I thought, well, maybe there's an opportunity in October for the Fed to tighten, but we know that 99.9% of the economists out there do not expect the tightening. That the markets aren't really anticipating it. But in the back of my mind, I was thinking, well, maybe this would be the meeting. Maybe this would be an opportunity. Who knows? It might be. We don't know. We don't know if the Fed is just at their wits' end and say, going from zero to 0.25 to 0.25 to 0.5%, have a liftoff before the end of the year, say that we're crazy, but we've got to start somewhere. I don't know how they'd explain it or whatever, but maybe just maybe they may surprise us, in which case we have to be prepared for that. So what do we know though from a technical perspective or from a fundamental perspective? And so I put together some charts here, and I think I left some of the old charts from last month just to show little changes from what we've seen. But so let's just rifle through these and continue on. Has the webinar started? I think so. Right. Anyway. If it hasn't, then someone let me know. But the U.S. CPI year on year, any reason for the Fed to tighten looking at this? I don't think so. I don't think so. So not a good sign there. But core CPI, if you take out the energy and food and energy out of it, and just take a look at the core CPI. We're at 1.9%, below 2%, a target level, but we haven't been above 2% going back to 2012. And so that's a problem. Does everyone else hear me? I assume people can hear me. Yes. So Sandy, you might have to go back out, and come back in order to hear me, but we're okay here. All right, there you go. Okay, so the core CPI, we're not racing to the upside. Obviously, we're sitting in a 1.6 to 1.99 range. Not a huge concern here. Not likely to get the Fed all that concerned. Now GDP, the second quarter GDP was nice and strong at I guess 3.9%. But they're talking, the trackers that are coming out with GDP estimates for the third quarter are somewhere like 1% or below for the third quarter GDP. So we go from down here in the first quarter to up here in the second quarter to down here in the third quarter. And again, not will the Fed tighten after a GDP quarter comes in at 1% or below? Um, Hard to see. The thing about the GDP here in the U.S. for those people to understand is that what the U.S. does in their GDP, it's different in different countries, but the GDP is calculated by taking the quarter-on-quarter change and then annualizing it. So just think about the quarter-on-quarter change for something like 4% is 1% change from the prior quarter, and then you annualize it. So you say one quarter is 1%, so 4 quarters is going to be equal to 4%, or 3.99%, close to that, and that's the way they get it. So something like 1% growth is going from a 1% GDP quarter-on-quarter change to a 0.25% GDP change. It's the same quarter of what it was the prior quarter, but 0.25% GDP growth, not a whole lot of GDP growth there. So the Fed's going to have a difficult time justifying it from GDP perspective. The core PCE, this is another major a measure of inflation, 1.3%, 3%, so lower than that 1.9% that we saw on the core CPI. So no concern there from inflation on that perspective. We saw existing home sales come out last week better than expected, and this is a bright spot as far as the economy goes, or one of the bright spots as far as the economy goes, is that home sales are increasing, or existing home sales are increasing, at least, and so they're near high levels, but the prices started to come down. And this seems what typically happens here, if you look at the median sale price here, is that you get a spike into June, and then things start to come off, and then you get a spike, and then you get into June, and then the price starts to come off. Pretty consistent. I mean, does this look very similar to what we see every year? Is this a price decline more than what we're seeing so far here? We obviously may see a little bit further more to the downside, but this move to the upside was better than this move, not as good as this move, and better than this move right here. But prices overall in the housing market has rebounded very nicely since 2012, moving up by about 44.57%. Now we don't see what decline through here that came before this month here, but I can tell you that the price did decline through there. So we're getting a rebound in the prices here, but nevertheless pretty good. More money in the consumers' pockets, which is always a good thing. So that's a bright spot. But we saw yesterday new home sales come out much weaker than expected, and not much change in the home sales going back to 2014. This is an annualized sales pace, so we're kind of back to those levels from 2014, 2013. But overall, not too bad. But the construction industry, again, we don't see what happened, the decline down through here. But and we've seen a steady increase from the 2011 low to the high. But it's well off of, I think we are down up to a million or so level annualized new home sales, and that is construction jobs were was a big sector of growth and incomes for those types of workers. They make decent money, so the construction industry still hasn't recovered fully, and are in trouble nevertheless relatively to where we were in 2011, 2012, 2013, and 14. We're kind of at those levels or just above those levels, so not too bad. The medium sale price also moving higher, similar to what we saw in the new home sales. Less of a seasonality thing that we saw in the existing home sales. In new home sales, people buy new homes. They build new homes. It's less of a, we're in the middle of the school year, so or school is starting, or that spring sales season where you get that push up into June, and then you get, things start to move off as people get settled for the school year. That's why existing home sales have that seasonality that goes along with it. Okay, so I understand that. So housing, I guess it would be, if the Fed were looking at the economy, or if we were looking at the economy, then housing is a bright spot of the economy, despite the little weakness, the weakness in the recent existing home sales data. Employment is one of the major bright spots, and if I were, I went back and thought, well, if the Fed were to tighten in October, what would be it that would cause them to tighten? Well, it's not inflation. We know that, but it potentially, but it could be employment, and employment situation has had a steady decline down to 5.1% unemployment rate. There was a time when the Fed was saying if the unemployment rate goes below, I think it was 7%, that they would sit there and tighten. At that point, this is when unemployment was above 10%. That if it got to 7%, that's when they'd start to take out the tightening. So we've gone another a big way in a steady decline down to the 5.1% that currently exists. So and this is what the Fed, when they say I expect to see liftoff, it's because employment is getting tighter. They expect that wages to start to go higher. And if wages start to go higher, that's going to lead to inflation, and we see 2% inflation down the road as a result of wages moving higher. Well, that may be the case, but when you have GDP growth of 1%, and the risk that maybe there's a global slowdown as well. I'll talk a little bit about that later. The unemployment rate may not have the continued momentum to the downside, or that brings that question of whether or not it could happen or not along the way. This is a non-farm payroll change in non-farm payroll, and this is a 12-month average of the non-farm payroll, 229,000. But we're seeing a decline in the non-farm payrolls over the last few months. And certainly, compared to 2014, where most of the months were above this 229-ish type of line, this year we have most of the months below that 229. So is that a concern for the Fed? And the Fed can and has in their speeches since the 142,000 last month, had comments to the effect that, with the unemployment rate of 5.1%, we can't add 200,000 jobs because we're already at full employment, or we're near full employment. And so there's only so many jobs that can be added at any one time. Now, when you add jobs to the, you would think like, well, we added 142,000 jobs in, last month. That seems like a lot of new jobs, and we've had this continuation above 0%, going all the way back to September of 2010. So every month we've added jobs. But you have to remember that there are new people entering the labor force every year, new college grads, new people, moms or dads working, entering the labor force to get higher income because the middle class is being squeezed. And so there's a natural addition to the employment ranks every month. Just a point of understanding for you. Can someone take care of Dia for that? Dia with the no sound from FX Street, if you can just respond to that, because I assume I am being heard. There is sound. I don't, so if FX Street if you people can hear me and someone says no sound, just tell them to do what you should do. Log out and get back in. Then we should see, I lost my train of thought. Anyway, the point is that as the as the economy, as the employment situation does get tighter, the Fed has to be concerned about the idea that that we're not going to add as many jobs each and every month, and so 100, what was 229,000, may become 142,000. As a and that might be a good number. Traders have to adjust to that. We have to adjust to that. So understand that the Fed is thinking in those terms, but still, there is a natural addition of new jobs into the market each and every month by new people entering the labor force. So just be aware of that. Be aware of that. The participation rate, I don't have a chart on that, but the participation rate has been declining steadily for the employment situation. What does that say? That says, it could be two things. One, it could be disgruntled or workers who cannot find the job, so they leave the labor force. It could also be retirees, baby boomers retiring, selling their homes while the existing home sales are high, selling their homes, cashing in on their home prices, moving to some place that it's cheaper, maybe a different part of the country, and living off their retirement nest egg, their home sale equity that they may have, and that may be causing the participation rate to go lower. It also could be on the negative side. It could be people being discouraged from working because they can't find a job because the economy is adjusting to more high-tech paying jobs, and the lower construction, manufacturing type of jobs, the middle class type of jobs are being eliminated. So there's this haves and have-nots within the job situation, and the Fed is aware of that as well. But they, when they talk about liftoff, and the Fed has sort of painted themselves in a picture, they have to make sure that that picture addresses the reasons for a liftoff. So if the Fed is going to make an excuse for a liftoff, it's going to be through employment. It's not going to be through inflation. It'll be through employment. Although we don't have inflation now, they may say that because of the employment tightening, that that's going to eventually lead to wage inflation. Wage inflation is going to lead to higher prices. Prices more, people are going to be earning more, and or there's more people working, so they're going to be earning, they're going to be spending more, they're going to be paying for goods and services, and the manufacturers and the service industries have to pay higher wages. Higher wages means that their profit margins are going to go down. So what do they have to do? To raise prices, and so on and so forth, and you start to get inflation. Whether or not that happens, we haven't seen it yet. I mean, we've seen, if the labor situation is so tight, how come we're not seeing the rise in things like PCE, core PCE, or in the inflation, even the core inflation, core CPI inflation still remains steady between 1.6 and 1.9. It's not 2.2. It's not 2.3. So we're not seeing that just yet. So the Fed may have to put on their rose-colored glasses and see something that we're not seeing. So let's take a look at the stock market. And this was another thing that that may allow the Fed a window. Okay, may allow the Fed a window to tighten in October. Okay, so we have to be aware of this. This is why, and we'll get to the trading side here, what to do and stuff. But this move back to the upside here, back over the 2,000 level, which was a 50% of this move to the downside. The 2,000 was a key level. We moved above that 2,000 level, stayed above that level in the S&P, and moved up to 2071. We're up 88% or 88% from this low right here to this area right around here. Let's call it 90%, and the high was 93 or so percent, 94% from our lows in 2011, trending. So that when you combine things like stock market moving higher, when you combine house prices moving higher, I understand that there may be people who aren't in the stock market who haven't been able to take advantage of this move to the upside because you're paying the bills, you're sending the kids to college, you're doing all that other stuff. Believe me, I know all about that. But there should be more money in consumers' pocketbooks. That may allow the Fed the opportunity to say that, like, well, confidence is high, although confidence came down here today. S&P index is higher, stock markets are higher, trading near high levels. We have this window to tighten by a smidgen of 0.25%, and we'll see what happens there. This is what it looked like last month. By the way, so this is this month. We're up here at the 2071 level or thereabouts. We were at 1978, below that 2000 level. So the Fed, we were still sitting here on the fence here, wondering if we're going to go down further here because we went below that key 2000 level here in the S&P. So I can see why the Fed might have refrained last month. And this might give them further confidence that, well, the window's open, let's take advantage of it. If we promise that we're going to have a liftoff, maybe we can talk it through here because of things like the S&P, and they can turn the story around here. This is what's happening now. Now let's take a little focus on what's going on around the world, because that's all of a sudden become a more important consideration for the Fed, and we hear it from certain Fed officials who aren't in the let's lift off in 2015 camp. We hear things like global growth is a concern, and a measure or a proxy for global growth or global economy comes from their stock markets as well. And so for the Euro stock index, we've seen a nice rebound here to the top side here at the 3414 level, up 71% from the low. We were in 2015, we started the year down here and moved all the way up here. This was a big, a nice gain, I think, close to 20% to the top side here. And then we took it all back, came right down to where we started the year here. And a month ago, we were probably right around this level. In fact, I have it right here, right around the 32.54 level down here. And so it was at this area right here where we're looking at last month, or here, I guess. Or it is right here. So we went down lower and then came all the way back out to the upside. So that's good news for the Euro stock index as well, that we're seeing a recovery in its Shanghai Composite. This is the China story, and this was last month. We were looking at this big surge to the upside here, and a big, huge plunge back to the downside, below levels starting off at the year. So China is, going to be a big concern. And although we are higher, we're still near the low levels here for China for the year, or near the opening levels for the year. Had that big, huge move to the upside, big, huge move to the downside. So the Chinese economy, second largest economy in the world, folks. I know, there's a lot of people, I'm reminded of when housing in 2008 and 2009 started to go to the downside, and they were saying how housing in the United States only is this amount of the economy. It's not going to have a huge effect, until it had a huge effect, and it had a bigger effect, and a bigger effect, and a huge effect on the economy. The second largest economy in the world, you start to think about emerging markets, you start to think about the knock-on effects through the European and other Asian economies as a result of China. And the U.S. is affected by what goes on in China as well. Whether we think it's that important or not. So it becomes a cumulative type of thing that's kind of sorts of add up and add up and add up, and so that is a negative. That's a negative for the Fed, and stock markets like the U.S. Admittedly, this was kind of orchestrated by the Chinese government officials, kind of shooting themselves in the foot by saying, buy the stocks, buy the stocks, buy the stocks, and then it crashed on their citizens there. But we're not seeing as big a rebound, of course, in the Shanghai Composite Index. So that is going to be a concern. You got to be concerned about the second largest economy. So that is a negative for the Fed to lift off in 2015, let alone tomorrow at their meeting. CRB index in September, we are down here at the 196 level. CRB is a commodities research bureau index. I think it's put out by S&P, and there is a Thomson Reuters or Thomson. I don't know. It's probably going to get sued for using CRB and not using the right name, but it was at 196 last month, down near the lows. It's not any better this month. It's at 192. So if you're looking for commodity inflation to pick up and lead to price inflation, it's not coming from the commodity sector. And then you look at things like crude oil. This was in September at 45.22, 43.53 as of last night. I think it's lower again here today. For crude, like 42 and some change I saw earlier today. So crude oil not getting the rebound. They're talking about producers producers of those oil companies who extract oil, big sellers of later contract months when the market went up to the 50 level. So if you're a extractor of oil in the United States or around the globe, you get a move up to a certain level, and you know that you can get that oil out of the ground at a profit below. Let's say you can get the crude oil out at $45 a barrel, and you can sell and hedge yourself and lock in a profit at $50 a barrel. You're going to do it, and that's what we saw here at the $50. Lots of open interest, lots of activity going on at the 50 level. So if you're looking for crude oil to rebound up to the 60 level or a 70 level, or go back up to the 100 level, that's not what we're seeing in the futures market here in the crude contracts. We're seeing sellers there, and we're seeing that price continue to move to the downside. Iron ore, another measure of China growth. Growth was at 57.21 per cubic ton, or however they figure out, 51 this month. So continuing to move lower there. That's not good for the Aussie dollar, the commodity currencies out of the raw material. Lots of raw materials come out of Australia, and so we'll see that. And then as far as yields go, the 10-year yield was at 2.27. What's the market saying now? 2.03. So down about 24 basis points since last month. So obviously the 10-year yield, it could actually go two ways. If the Fed were to tighten, that might flatten the yield curve, cause inflation expectations for the future to come down. But when you're talking about 2.03% for the 10-year yield, and inflation, if they expect inflation to be 2% or above, that's not a lot of inflation expectations or concern about inflation in the 10-year yield section with the 203 rate. And as far as the 2-year rate goes, we were up here above the 80 level. This is more of an indication of the market's anticipation that the Fed is going to tighten. We were up way above the 80 level, around the 81 level at the last Fed meeting. Down here at the 62 level here, 0.62%. So no expectations of the Fed. And the dollar index was at 95.76. At 96.72 now, so little change from the prior month. So that's not how it is fixed. So so the purpose of that, folks, is that to give you kind of a broad overview of what the Fed is looking at. We went through a lot of different charts of the trends that are going on within the economy, and we sometimes as traders get so wrapped up in the minutia of what the last data point was, and not take a big picture of the overall picture that's going on in the economy from a domestic standpoint, even from an international standpoint. I could go on and on and on, of course, and you could as well by looking at other charts like, from a global perspective, what's going on in China. Saw an article that the malls, no one's in the malls in China. You can go on and on and on, but overall, what are the my opinion from what we saw there, that we have a housing market that's rebounded. Yes, yes, but it may be peaking. We saw that in the new home sales start to come down. We saw existing home sales and median prices start to come down as well. We see the employment situation improving. Proving unemployment, that's unequivocally that the unemployment rates moved to the downside. A little bit concerning is the number of jobs that are being added. I know you can talk your way out and say that as we get to more full employment, that you're going to add fewer jobs because there's just not many of the jobs out there anymore, because it's full employment. But that may also start to worsen if things like GDP continue to move to the downside. We don't get that increase in the demand side that's going to justify having a higher or lower employment rate, a full employment. So it can start, the apple cart can start to get a little bit wobbly and start to move to the other side. But so I may have my opinion that, okay, there's no chance, and then the global concerns are obviously a problem. There's no chance that, or little chance that the Fed might tighten tomorrow, or maybe even in 2015. But does my opinion matter? And the answer to that, as a trader, is no, because I can think all I want, but it's what's going to happen for at tomorrow at 2 o'clock. Will the Fed surprise us with a 25 basis point increase? I actually think if they're going to do it, might be the best time to do it, again, for those December reasons, but I could be wrong there too. What doesn't matter what I think. So thinking and having that fundamental perspective is good, but if the Fed's going to sit there and tighten, and I think there's no chance that the Fed's going to tighten, and they go and tighten, I better be prepared for that. Okay, prepared for that as a trader. And even if the chance is 0 or 10% or 15% that the Fed would tighten, if I were to go into with a position and the Fed did tighten and no one's expecting it, that would be very painful. I would be I wouldn't. If that would be very painful. That you can imagine the amount of money that I could potentially lose on that trade on the surprise. Okay, even if it's 10 or 15%, there's still, the Fed said there would be a liftoff. There's only two meetings. There's October and December. The stock market's higher. The unemployment is low. The inflation. You can ignore all the bad things, but if they focus on the good things and say, we want to have liftoff, we want to start this thing, let's get it going. There are plenty of people out there who say the rates have been low for too long already. So if they're able to persuade those other people on the FOMC board to vote their way, maybe they get it. Maybe they get it. Maybe, if Janet Yellen changes her scope and goes the other way and says, I've been promising a liftoff, I'm going to give it. Maybe they do it. But that says to me, for me, risk is too great. I don't want to lose two big figures or three big figures on some sort of bet. Okay, especially if maybe the market's priced in no change. Okay, priced in no change. So for me, the risk is too great. The market is likely to be extremely volatile, especially if they do tighten. There could be a sharp moves up and down. Even if they keep rates unchanged, things are going to be going on in the statement, and there'll be different things coming out in the statement as well. They're going to be looking for. I'll talk about that in a little bit. And liquidity will probably be lighter, as traders spar back and forth between what they think, and then how is the stock market going to take it is going to be a big idea. And then we're going to have things like the risk on, risk off trade, depending upon what the stock market does. How does the stock market feel about a Fed tightening or no tightening and stuff like that? So all these things go into my mind from a trader's perspective when we have a key event, okay, a key event um, that it's the surprise, it's risk that you're taking on that event that is a worry, and also what the bond market says. So what can we do as traders? And what we can do as traders is trade after the event. After the event, all the details are known, and that will give us that will allow us to get rid of the event risk um, in our trading. Again, if it's a 10 or 15% chance that the Fed were to tighten by a surprise, you just give that. If that happens, you're going to lose a lot of money. If it doesn't happen, and the market is sure that the Fed's going to tighten, what kind of movement are we going to get? So the risk, it's kind of like that Swiss franc trade. What is when they got rid of the peg, what was your risk of or what was your reward from them not taking or keeping the peg in place? Well, the Euro Swiss would move up a little bit. What was your risk if the Swiss National Bank took off the peg? A huge move to the downside. So when the skew of the risk and the reward gets really huge on one side and very little on the other side, it makes me wonder, like, don't be involved. Wait for the event to happen and then be involved, because if the market's going to move a long way because of a surprise tightening, perhaps, then I'll wait for it. I'll give up the first part and try to get in at a decent level on the move, on the subsequent move. So what I like to ask myself is, what would be bullish fundamentally for the U.S. dollar, bearish for the euro dollar? And there are two things. One, a Fed tightening. That would be bullish for the dollar, and the Fed said that they would absolutely tighten in December. Not that there's a chance of a liftoff or that we expect or whatever. It would be that folks, we're going to tighten in December. Okay, it's time for liftoff. We're going to tighten in December. If it becomes a thing like we're going to look at the data and all that other stuff, I don't want to be involved. I don't want to be involved. But if they say unequivocally that the Fed's going to tighten, or either the Fed tightens or they say that we are going to tighten in December, then I think that has the opportunity for the dollar to get bullish and the euro versus U.S. dollar to head to the downside. I'm using that as a proxy to the euro. Okay, same goes true for the dollar yen or the pound or whatever. The dollar should get stronger. So what would be more bearish fundamentally for the U.S. dollar and bullish euro versus U.S. dollar? I would say that the Fed saying 2015 liftoff is not expected, and not expected. We don't expect to lift rates in 2015. We're, the economy is not strong. The inflation is, or the global concerns are more of a concern that inflation is not picking up. That that we don't expect it to go higher. That GDP growth is lower, and that we expect that that liftoff is off the table. If they come out with their usual stuff like, well, maybe in December, blah, blah, I don't want any part of it. I don't want any part of it. I'm gonna, I would shut off the screen if I didn't have to work. But as far as trading goes, no interest at all. No interest at all, because it's gonna be a boxing match. And if I were to trade, it would probably be. It'd probably be a disaster. So I think there's better opportunities to trade. There'll be better opportunities to trade after the event on Thursday, on Friday, stuff like that. So as a trader, what I like to do, and what you should do as well, is think of the surprises. What would be the surprises that would cause a trend-like move, or a bigger move, or something that's going to take us outside of what is the norm? Okay, and the norm is nothing. Okay, no change. Expect a lift off in 2015 still, or that is a chance for a December tightening. What would not be the norm? A hike, or unequivocally we're going to tighten in December. That's on the bullish side for the dollar, and on the bearish side would be nothing's expected in 2015 because of this, that, and the other, and all that other stuff. So those are the things. So if the Fed decide, where can we see the euro? Where can we see the euro versus U.S. dollar going becomes the next question for me. So if they were to do something, do the surprise, where we see the euro going, and if you know your destination potential, you can trade with more clarity. That's the importance of understanding where you are going or potentially go. So I put up the euro. Finally, we get to something chart and how to trade this thing. But well, this is kind of important, and it's kind of the progression that we have to do as a trader. So if you take a look at the euro versus U.S. dollar, and this is a daily chart of the euro versus U.S. dollar. I'm going to add some stuff in here. So this trend line coming up, I have this trend line through here, and I have a bunch of different highs up through here. And let's talk about this, where we are. I don't know where we are at right now as far as the euro goes. Maybe someone can put that in. But we do know something from our technicals that would give us a bias. Technicals allow you to have a bias as far as where the market should go, and I encourage you to kind of go through this process yourself with the euro or the yen or your favorite currency pairs. I'm not going to have time to do all of them, and I'm just here to kind of show you what I do, how I do it, and then you can do the same thing. But what the technicals do is they allow you to have to develop a bias, okay? A bias and then targets, okay? Bias is either bullish or bearish, and targets become where you're going, okay? And so if we were to expect, or if we were to see that the Fed was going to, that the Fed tightened tomorrow, and we're at this area right here, where would you expect the price to head toward? And I would expect that the price would head toward that a area that the price could go toward is right here. Right at the 108.07 to 108.63 level. We're at I don't know 110.30 or something right now probably, or 110.36. So we have the we have the opportunity to head down to test this area right through here. Again, the Fed would be tightening. The euro should get weaker, the dollar stronger. We know that in the eurozone, they're going to probably ease. So that would be the minimum for me, or I would think that this would be a pretty good bogey, or a pretty good par for the course to get down to this level right here. And we could even go lower between now and the end of the year, move our way down to our low levels if that be the case. Again, Fed tightening, euro easing, all bearish for the euro versus U.S. dollar. So if I know that the destination is over here, we would expect that. So you have this idea that we're going to there. Now, the market is obviously going to gap. Now we may come down to this 109.39 level and then retrace back up to 109.75 or something like that. What levels would you expect the market to stay below, or where would be your targets along the way? And then you expect the trend to continue. Well, the first target comes in the 109.94 level, and then we get down to the 109.39. So this is step one, this is step two, this is step three, this is step four. If you know the steps that where you're going in this, you can lean against once you move through a level, or you can look to get below, anything. If I can sell below anything with the 109.90 handle, I would do it on number. If I can sell anywhere at 109.39 level, if the market goes below that level, I would do it as well. So as far as trading goes, only if the Fed were to tighten, I would expect that the market would eventually get down to this 108.07 level. It may not get there tomorrow, but I expect that over time we're going to head down to that level. And what levels would I want to see the price stay below? I'd like to see the price stay below the 109.94 level. I'd like to see the price stay below the 61.8% at 109.39. And then, so anything, I lean against those levels to trade on the short side, looking for the market to move to the downside. Now, what are the levels on the upside? Again, the upside would be that the euro goes higher, the dollar gets weaker. And that would say that the Fed is taking off the liftoff idea. The Fed is expecting that the market that the that rates stay the same for a long for into 2016 and beyond. And in this case, I would look for the market to move back above the 200-day moving average, 100-day moving average, and especially this trend line here. You see this trend line connects these lows right here in the 100-day moving average, comes in right near that level and the trend line. So any sort of move above that level would be more bullish for the euro versus US dollar. I would putting it another way, I would expect if we move above that level that the price should not move back down below that level, so traders can lean against that and move to the upside. If I were to have a bias though for this currency pair, the best trend scenario would be to the downside. Why? Because a couple reasons. One, the euro situation. Draghi said that he would expect that that there could be more, or he was more dovish in his comments, and that could be an extension of the QE. So that's more bearish for the euro. We saw that in this day right here. Also, if the Fed were to start to tighten, we know that they're leading that way. So that should lead to further downside potential. Hence, the idea that we could head on back down to the 104 level by the end of the year, but certainly down to this 108 level is a doable situation. On the other side, if the Fed were to say that they are not going to lift off rates anytime soon, then the euro still is likely to increase their quantitative easing. But in the case of the euro, the U.S. dollar, we're just going to maintain our rates. So that's still bearish for the euro because of the euro situation. So I'd expect that this ceiling area up here around the 114.35 to 65 level would keep it in place. So you can do this type of so when you look at when you trade these types of key events, in summary, try to have those situations where the extremes can happen, where the market has a potential to trend. If it doesn't have the potential to trend, it's just going to be a boxing match. It's going to be a barroom brawl. People are going to go at it from one side to the other side. Once you understand what your dimensions are from a fundamental perspective, from this will be a surprise on the upside, this will be a surprise on the downside, look at your charts. I like to use a 100-day moving average. I like to use a 200-day moving average. I like to use trend lines. I like to use Fibonacci retracement levels. Map out a plan where you're going, step, 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 step. If we get through those levels, use those levels as resistance or support, depending upon which way you go, and lean against those levels to define your risk and limit your risk. Also understand how far can you go? Can we go down to 108? Yes, we can go down to 108. Look for it. That gives you more confidence. On the top side, can we go up to this level? Yes, it might be a little harder to do, so be more cautious in that direction. I need to wrap up. They're telling me they're pulling the hook and sending me off. So I want to thank everyone coming in here. I'll write other things on our website between now and tomorrow's decision about the levels. So you can go to our website at forexlive.com to read more about it. And I'll do not only the euro, I'll do the dollar yen as well. So thank you very much. Please, no matter the instrument, are you a permanent bull or a permanent bear? Thank you. No, not. I think in this market environment, you have to kind of play both sides of the market. Just look at the up and down activity that we've seen here. I would become more of a bear. Trend type move if the Fed were to tighten with the surprise tighten and somehow the stock market benefits and everything else goes in the right direction. So, all right, I want to thank you all. Hope you learned something here today. Good fortune with your trading, and again, pay attention to forexlive.com. We'll have more commentary from a technical perspective and fundamental perspective between now and that big decision tomorrow. Bye bye now.